Yes, you're live, sir. Ma'am, can we start? You can start.
A very good evening to all the members who have registered for this session. I take immense pleasure and privilege in inviting you all for this session on issues relating to GST in the real estate sector. So today we have, like, GST is one area. From the time it was introduced, we have lots of circulars, we have lots of notifications coming on a daily basis. And now we can say it is kind of stabilized, but this is one sector where we have queries every now and then, especially like who can claim the input tax credit, or whether real estate real estate parties or the kind of buildings, whether new buildings attract, sale of new buildings attract GST, or whether it is only the ones which is say for example, the ones which is already occupied, whether it attracts GST. So there is a lot of confusion in the GST sector relating to this, especially with respect to availment of input tax credit. So today we have faculty, V. Shankara Narayanan, sir, who is an expert. I can say he's an expert in this particular area. So sir has almost around 1.5 decades of experience, especially in finance, in GST, as well as in compliances. And I think when I was reading sir's profile, the very catchy thing was sir is actually a member of the GST study group of ICAI and also a master trainer of GST affiliated by the ICAI. He has trained more than 5,000 chartered accountants and around 9,500 finance professionals in this particular area. And he's also a member with the Governing Council of International Chamber of GST Professionals, and also the Indirect Taxes Committee of Hindustan Chamber of Commerce, and also the Madras Chamber of Commerce and Industries. Sir has also authored and reviewed various publications on SENBAT and GST under the heading of ICAI, and also he's also a speaker and trainer for ICAI, ICWA, as well as the Company Secretaries Institute. Also Commercial Tax Staff Training Institute, Tamil Nadu, National Academy for Customs, Indirect Taxes, as well as Narcotics. And he's also a trainer with the Regional Training Institute, CNAG, and the ICT part of the Niti Ayog initiative. So I think we will not be having a better faculty to take this a very relevant topic for the day. So I think it is my privilege and honor to welcome you, sir. Sir, the session is all yours.
Thank you, ma'am. Good evening to the participants who have connected through this online mode for the virtual session. Issues in real estate with respect to GST is what we are going to discuss in about close to 2 hours from now. That is what is going to be our topic of discussion. Wherein, who would have thought that even TRAN credit would have become a point of discussion after 5.5 years of GST. Now, last month, we did have a scenario where TRAN credit was reopened, and many of the real estaters were trying to stake their claim of TRAN credit by filing the TRAN credit, which they missed the bus in the initial stages of GST, when originally the TRAN credit was made eligible way back in 2017. To set the context for our discussion, I think TRAN credit would be the right place to start. But before that, now that we have gone back to TRAN credit, let's go a step further back and try and understand how the taxes were earlier and why it makes sense is GST actually had a provision which still continues to be there, which is in a way making the older transactions also taxable under GST as of today. How does it happen? That is what I wanted to highlight in the first place. Now, prior to GST, the construction sector as such, the taxability was twofold. We had the VAT playing its part, as well as service tax. Both had their own methods of valuation. And the methods of valuation suggested at times we ended up paying taxes on a taxable value which is more than the actual value at which the apartments or buildings were constructed and sold. But that is how it was. So we had the concept of deemed sale, Article 366, Clause 29A, coupled with the levy of both service tax and VAT. So slowly we migrated into GST. And we migrated into GST. Little did many of us know that in GST, the whole idea of works contract was turned on its head, and it involved an enormous change in understanding. In what way did works contract undergo change, and in what way did GST make the change and distinguished works contract from construction? Is by the introduction of this definition in 2 subsection 119, by stating what is a works contract. In that, they had gone at length to explain what is works contract is only what is in relation to an immovable property. It could be any kind of construction, erection, commissioning, fabrication, installation, fitting out, repair, maintenance, alteration, renovation. But it should be in relation to an immovable property. Only then it shall partake the color of a works contract. And works contract for the purposes of GST as per Schedule 2 of the CGST Act were termed as supply of service. Yes, there is a supply of material involved also, and which is what was prompting the deemed supply as per Article 366 Clause 29A prior to GST. But once GST had come into picture, there was no intention to have a transaction hanging in between goods as well as service. So the intention was to either classify a particular activity as supply of goods or as a particular activity as supply of service. Schedule 2 did the job by stating that any kind of such construction or any kind of such works contract under GST shall all be treated as supply of service. It is not direct supply of service. It is taken as a composite supply of service, considering the value of material that is involved in the transaction as well. So this was the first change that we had to get accustomed to once GST came into being. Now, is that all that was there? No, there was more in store. And this is the key provision, which, as I said a few minutes back at the start of the session, made a TRAN credit relevant for a real estater even in the last couple of months. How? Section 142 subsection 11 clause C stated that if any project that was started prior to GST, but that was not completed prior to GST, that was still ongoing at the time of GST being introduced, that is 1st of July 2017. And that project gets completed post 1st of July 2017, the taxability of that whole project will be under this act. Legal questions have been raised whether 142 subsection 11 clause C can be a charging section. Now that is something that needs to be decided in a court of law, but the intention of the lawmaker is very clear that the tax shall be leviable under this act. So the projects that were ongoing at the time of introduction of GST, the taxability had to be done in GST. Now, if taxability had to be done in GST, what happens to the VAT or to the service tax that has already been paid on those projects? Take, for example, a person had gotten into a project where it is completed, let's say 70%, as on 1st July 2017. In that project, he had made some sale, gotten some money, on account of which he had become liable to pay service tax as well as VAT, which if he had remitted, and subsequently finds out that GST has come into being from 1st July 2017. So even for the amounts that I have received prior to GST on account of a project which is continuing from the old era into the GST era, I am liable to pay the whole tax under GST only, which meant the whole transaction, the GST needs to be paid. it is not only that portion of the project which is completed after 1st of July 2017. It is the whole project. The taxability is under GST, which meant the service tax and the VAT that has been already paid on the project, how to treat the same. That is where, again, 142 subsection 11 clause C gave a provision to a taxpayer to avail the tax paid as VAT in the earlier regime, transition it into GST, the tax that is already paid. Now, this is not the tax that is carried forward into my GST. This is not carried forward in my return. This is a tax that I already paid in my return, which is filed under the VAT. Now, that tax that I have paid can be carried forward into GST as SGST transition credit. Same way, the service tax that I had paid on account of that project, I was allowed to claim that amount as transition input tax credit, CGST, into GST. This is what was the most important transition credit provision pertaining to real estaters, which many of them did not make use of. And that had resulted in multiple issues, including the action being initiated by the GST officers, especially real estate sector, even by DGGI, wherein they had demanded the whole tax to be paid under GST, notwithstanding the fact that already some part of it has suffered a tax in form of VAT and service tax. Because the department's view was straightforward. If you had not availed the transition credit, I'm not going to give you a transition credit now. Hence, the GST has to be paid on the full project. Then came the ray of hope by way of reopening of transition credit. So this issue ideally should have been resolved by filing of transition credit in the last couple of months. That is, from October to November, it was made open pursuant to the Honorable Supreme Court's direction, which was opened up by CBIC with elaborate instructions being issued. Accordingly, all the real estaters who had missed the bus earlier in 2017 should and must have taken benefit of it. And 142 subsection 11 clause C having been already enforced by the department in many of the cases, even for those real estaters for whom it was not enforced, they should have learned from others' mistake, and this compliance should have happened. And if this had not happened even during the window of last 2 months, then there is no way that the tax that is already paid in the form of VAT and service tax can be reclaimed. That is the challenge that the real estate industry faces as of today. Hence, I would say the most beneficial in the sector in whole of this reopening of transition should have been ideally the real estate sector. Most of them had realized it and they have taken this transition credit. So 142 subsection 11 clause C has an issue, but also had a solution which should have been made use of. Now moving to the next part of our discussion, which is the one relating to the classification of coupled with the taxability of a real estate related transaction. The construction related transaction. Construction of a complex building or a civil structure. Yes, this is what is called as a construction service. Where it is intended to be sold to a buyer, then only it will be called as a construction service, because mere construction would only form part of works contract. Where I am constructing and selling it, there is an element of land is also involved. That is when it will become a real estate transaction. It will become a construction transaction. And there is an exclusion which finds a place, which being except where the entire consideration has been received after the issuance of the completion certificate. Not even a single rupee should have been received before completion. then only the exclusion benefit can be enjoyed. If even a single rupee of advance or a smaller amount as token advance is collected, then that becomes taxable. Here, I wanted to clarify one practical question which was asked by some of the real estaters as well as the practitioners, where they asked me a question that it says where the entire consideration has been received after issuance of completion certificate. We did receive some part of the consideration before completion. Let's take an example numerically. 31st of December 2020, the project got completed. I had received advance of 40% for an apartment before 31st of December 2020. The remaining 60% I'm going to receive after the completion. Now the real estater was asking me, am I liable to pay GST only on that 40%? Because that is the amount that is received before completion. And technically the amount that I'm going to receive after completion is going to be that 60%. So by virtue of this exclusion, am I going to enjoy that exclusion benefit and say I don't have to pay GST on that 60%? It is not the correct interpretation. It is not the intention that is interpreted here. Why? Because that unit for which a 40% advance had been taken becomes fully taxable irrespective of when the money is received. Now that a part of the money is received before completion, that is 31st of December 2020, the whole consideration for that apartment is taxable even if it is received after completion. I'll repeat, the whole consideration becomes taxable for that apartment. Maybe there is another apartment in the same complex which never got booked before completion. It got booked only after completion. Any money was received only after completion. Then for that apartment for which no money was received prior to completion, everything was received only after completion. For that apartment, there is no need to pay GST. It gets away from the purview of GST, courtesy this exclusion. And later on, we will see that Schedule 3 also carries this exclusion. Hence, this needs to be interpreted from the point of view of what is being sold as against not the money that is being collected. It is not about the quantum of consideration. It is about the plot or the flat or the portion of the building which is getting sold. If any advance is received before completion, any money is received, then the full consideration for that particular apartment or the building becomes fully taxable. If it is segregatable apartments and one is received, one is not received, the example that I cited holds good. And the other issue is completion certificate. Is it mandatory? There are two scenarios where the completion certificate need itself would not arise. Scenario one, when the project itself is not covered under the RERA, the Real Estate Regulation Act, then there is no question of GST or there is no question of completion certificate based GST on the project. Then how do I determine when it got completed? For that only, they had given an option that it's first occupation. So when the completion certificate is mandatory, take the completion certificate which is given by a competent authority. When it is not mandatory, we need to go by the second option, which is after the first occupation. How to determine the first occupation? It differs from state to state. For example, in the state of Tamil Nadu, only when the drainage connections are given, when the no objection is given by the electricity, when the conversion of the electricity from commercial to residential happens, that is when the first occupation happens. If it is going to be a commercial space, then of course, yes, the EB will be converted into a normal connection, electricity connection, as well as the drainage and other facilities given by the municipality, panchayat or corporation are given or reaches a finality. That is when it is fit for occupation. So those scenarios, we need to look at the second option. Hence, completion certificate need not be insisted upon where it is not even required. So another issue that is to be addressed is only when it is required, completion certificate needs to be scouted for. Else, it is not required. The date of first occupation can also be the driver for our taxability or otherwise, or to determine the project's taxability from the perspective of GST. Now moving to the next part, which is how the taxability gets excluded in Schedule 2. The part of it is also there in Schedule 3 to say that this will not be treated. This will not be treated neither as supply of goods nor as supply of service. Neither as supply of goods nor as supply of service, only when it is falling under Schedule 3. And the wordings of Schedule 3 is what I have reproduced, which you can see on your screen. It says, any sale of land and sale of building. Now they have carefully worded by inserting a comma saying subject to Schedule 2 5B, which is what we are just seeing. So the subject to Schedule 2 5B is no part of the consideration should have been received before completion. Only then it will get qualified for Schedule 3. In other words, I'm revisiting my example that I gave before 31st of December 2020. One apartment consideration partially received, that apartment will continue to be taxable, whereas the other apartment for which nothing was received, that apartment will qualify to be called as no supply or non-GST, and that will come under Schedule 3. This is what is the major exclusion that happens with respect to taxability of a real estate transaction. Two parts, and the two parts are Schedule 2 and Schedule 3. Schedule 3 talks about the exclusion. Schedule 2 also talks about the exclusion with a condition: when that exclusion is not qualified, becomes taxable as a supply of service. Now, before we go further, the burning question around real estate industry is about the plotted layout that is being sold. Now here, we need to clearly understand that what is being spoken about, especially with respect to sale of plots. The sale of plot is clearly a sale of land. In what way it is different from an apartment scenario where also there is an element of sale of land? It is clearly different. That is, sale of a plot of land is clearly different from a sale of apartment, because in an apartment, what is being sold is an UDS, undivided share of land. This undivided share of land is not earmarked. It is a particular square feet of area which I am entitled to, but it is not earmarked. I cannot say it is on the entrance, it is in the rear. I cannot say anything. It is a combined ownership. Whereas in case of a plotted piece of land, it is specifically identifiable. It is in my name, for which I tend to pay the property tax and other land related taxes. One. And second is, when land alone is being sold, land being an immovable property which is excluded from the definition of goods, there is no question of GST on the sale of land. Then how come it is becoming taxable in case of sale of apartment? Is it is not becoming fully taxable. It is enjoying an exclusion, which later on we will see when we come to valuation. Hence, when a sale of plotted land happens, there is no question of GST on the transaction of sale of land. Now, the situation might be a little twisted. That is, one person develops, one person is the owner. The developer collects the money from the person who is buying the land. Now here, there are two elements in the consideration. One element is the land value. The other element is development charges. If development charges are collected, 100% the development charges is taxable under GST. Because it is in relation to land, I don't deny, but that is a service that is being billed now. For a non-GST supply, can I bring about the composite supply concept? I don't think that is possible. Hence, if the development charges are going to be charged separately, there is 100% chance of GST on the development charges. The development charges are charged on the landowner. The landowner pays. Will there be GST on the development charges? Yes. Now that is a distinguishable separate service that is received by the landowner, and for that service there will be GST liable to be paid. Hence, plotted land, the sale of it is completely different, and if it is, as I discussed, going to be a scenario of sale of land only, there is no question of GST on the sale of land. Now this can get complicated in the third possible way, which is what I have seen as the most complicated way, that is sale of plotted land along with a construction contract. Now here again, if the land value can be separately segregated and shown, and that contract is separate, and the construction contract is separate, the construction contract would technically get qualified under works contract, and it will not go under the construction contract. Hence, we need to be able to segregate the sale of land alone, sale of land and building as envisaged in Schedule 3 vis-a-vis the development charges before we proceed further. Hope I have given clarity to that point. Now we'll progress to the next point, which is the most important or the common type of transaction which we have come across, the joint venture. Now that is what I'm going to take you through. The joint venture. Simple scenario is what I have taken with 3 people in contention, and from there we will build upon the taxability as envisaged by the GST legal provisions, and then the issues specifically from every person's perspective. There are 3 people who are involved in a joint venture transaction. It could be a simple 3-person scenario. It can be developed into a 4-person scenario. How into a 4-person scenario? I'll explain that. One, there is a landowner, then there has to be ultimate buyer, but in between a builder cum developer could be there, or there can be a scenario where the builder is a different person as against the person who is a developer. If that is the case, this can become a 4-person involving transaction. As I said, for the sake of brevity and discussion, I have kept it as 3 people who are involved in the transaction, and how the joint venture works and how GST envisages the taxability on this whole scenario. The landowner, who is the initiator, at his instance, the transaction happens. What does he do? The landowner is either approached by the builder cum developer, or he approaches the builder cum developer, and he is vesting the development rights to the builder cum developer. Now, interestingly, the legal provisions of real estate underwent a change from 1st April 2019. So for the period prior to 1st April 2019, this was different. How? The development right that is given by the landowner, he is getting a consideration. Hence, the service rendered by the landowner was made liable to pay GST under forward charge or normal charge. We are talking about the scenario prior to 1st April 2019. The builder cum developer, who is rendering a service to the landowner, wherein he is constructing and giving the completed apartments, where there is a sharing. The landowner expects completed apartments. Let's say 100 apartments are being constructed, out of which 60 is being given to the landowner, 40 is being retained by the builder cum developer. In those cases, the 60 that is being given to the landowner, there is a service that is being rendered by the builder to the landowner, for which GST becomes applicable as a construction service. Though there is no element of land involved in it, it is a construction that is being done. And then the ultimate buyer of the apartment, either buys it out of the landowner's share. Out of that 60, he buys one, or out of this 40, he buys one. Depending upon when he is buying it, either before completion or after completion, the liability is cast on the buyer. In either case, that is whether he is buying from the landowner or from the builder cum developer, the liability to pay GST occurs only when any amount of money has been paid prior to the completion of the building. If that has happened, then GST becomes applicable on the buyer. Now that is a construction service, and it is a normal charge wherein, be it a sale by the landowner or be it a sale by the builder, GST is liable to be collected from this buyer and be paid by the person who is making the sale to the buyer. It could be the landowner, it could be the builder cum developer. Now, this is how the scenario was prior to 1st of April 2019. This underwent a change. The change that had happened and which resulted in the shift of liability is something which we will see as we go through. The change of taxability happened in one scenario, that is the development right, which is given by the landowner to the builder cum developer, became taxable under a reverse charge in the hands of the builder cum developer. This is the major change that happened from 1st April 2019. Now, this became an additional tax burden in the hands of the builder cum developer. Now, even before 1st April 2019, it was a burden on the builder cum developer because the builder cum developer had to pay the GST to the landowner. But now it had become a reverse charge scenario with certain conditions attached to it. That is a change that happened in this. Barring that, all the three of them have the liability of GST, forward charge, or under reverse charge, or both. Let's go dig deeper into the compliance expected out of each and every person. The change from 1st April 2019 was shifting from the GST defined mechanism into the RERA based mechanism. The Real Estate Regulation Act had suggested, or it had some definitions which was borrowed for the purpose of GST. Based on that, the taxability of the real estate transaction was changed. To start with, the definition of residential apartment was borrowed from RERA, which said that any apartment which is intended for residential use is declared as a residential apartment. And what is a commercial apartment is obviously whatever is not a residential apartment was termed as a commercial apartment. And further, it went on about defining what is a residential real estate project. A key definition which is very important to determine the taxability of the projects from the view of GST, starting from 1st April 2019. So what is an RREP, residential real estate project? A residential real estate project would have to be a one where out of the total carpet area, now it is not the total constructed area, it is not the plinth area, it is the carpet area. Out of the total carpet area that is constructed in a real estate project, not more than 15% should have been given for commercial purpose. In other words, up to 15 can be given for commercial purpose. Still, the project would be deemed as a residential real estate project. Take, for example, 10,000 square feet is being constructed in a residential real estate project. Then, not more than 1,500 square feet should have been sold for commercial purpose. If it exceeds 1,500, it loses the capacity to be called as residential real estate project. If the number of square feet that is sold for commercial is going to be 1,500 or lesser, then the project can be called as a residential real estate project. But there are further conditions that which are attached to determine whether an apartment can be called as an affordable residential apartment. The term affordable residential apartment itself, I would say, is one borrowed from the provisions of RERA, but still I wanted to use the term affordable with a restricted sense, because if something is unaffordable, nobody can buy. So the word affordable is to be used for where we can say that the projects where the cost is little lesser and the size is little lesser. That is how it should be construed for the purpose of our discussion. So when I say an affordable residential apartment, from the RERA, the definition flows that any residential apartment which is having a carpet area not exceeding 60 square meters, if the project is going to be, the apartment is going to be located in metropolitan cities. And it is not just metropolitan cities, it includes the other cities as well, like for example, Bengaluru, Chennai, Delhi NCR, Hyderabad, Kolkata, and Mumbai. 60 square meters is the restriction there, and other localities other than these, it is 90 square meters in size. Roughly, you will see it is 640 plus square feet plus 940 plus square feet is what this will get converted into. The carpet area has to be equal or lesser than this, plus another condition that needs to be satisfied, which is the gross amount charged should not be more than 45 lakhs. Is the combined condition that needs to be fulfilled. If these two are fulfilled, then, or I would say these three are fulfilled, then that apartment can be called as an affordable residential apartment. Taking things further, the taxability, the tax rate, how does it change? Where does it change? And how the taxability pans out? In case of a residential real estate project, RREP, where the commercial element or the commercial space is not exceeding 15% of the overall carpet area. In that case, how the taxability happens under GST is as follows. If it is going to be in that residential real estate project, an affordable apartment, there can be others. As I said, it is not non-affordable, it is other than the category of affordable. And then we have commercial as well, because you can have up to 1,500 square feet of, that is the example that I gave, 15% of commercial space as well. All the three are possible inside a residential real estate project. Then how the tax rate? From 1st April 2019, this is how the tax rates have been notified. Courtesy notification number 3/2019 to 7/2019, multiple changes were made. First up is the affordable residential apartment. The tax rate shall be 1.5% with no input tax credit. But we would have seen that it is being charged at 1%. The reason being, there is a 1/3 of deduction allowed for the purpose of land. When this 1/3 is reduced, it can be either reduced from the value and 1.5% can be charged, or from this 1.5%, 1/3 can be reduced and that percentage can be charged on the whole value. The latter is being followed by most of the real estaters. Hence, the effective rate of 1% is what we get to hear often. That for affordable housing, the GST is 1%. It is 1.5%. In other words, 0.75% CGST, 0.75% SGST. But it is not disclosed that way. It is not being discussed that way. It is being looked upon as 1% effective rate. Nonetheless, it meets the amount. So whether you multiply on the former or on the later, the answer is going to be the same. The tax liability is going to be the same. As long as that is getting paid, there is no qualms that might arise from the department as well. There is no input tax credit. Hence, this amount has to be paid by cash only. So absolutely no problem, whichever way it is calculated, as long as the value is the same. This is one element or one part where it is a affordable residential apartment. If it is going to be others other than this affordable category, then in those cases, what happens? The GST rate for that residential apartment other than affordable shall be 7.5%. That is 3.75% CGST plus 3.75% SGST without any input tax credit. Now, this also is eligible for 1/3 deduction on account of land. Consequently, the effective rate becomes 5%. So there is no question of ITC. Effective rate is 5% for any apartment other than the category of affordable. Inside the same project, there can also be a commercial space that is getting sold. For that commercial space, since it is part of a residential real estate project, the tax liability would be 7.5% without any ITC, similar to a residential non or other than affordable projects taxability only. This is very unique because this is applicable on a commercial space, but which is located in a residential real estate project. And further here as well, the 1/3 deduction for land is allowed, then the effective rate becomes 5%. On the topic of 1/3 deduction for the purpose of land calculation, we will discuss after we complete the discussion on the rate. So this is pertaining to residential real estate projects. Now, my project is not a residential real estate project. Then how does the tax liability occur? I've used the word commercial real estate project, but you can say it is a real estate project. There is no commercial real estate project per se. I have put the word commercial to distinguish it from residential real estate project. Now here, a real estate project which is not a residential real estate project, also there can be three possibilities. The possibilities being there can be a affordable residential apartment inside the same project. There can be a residential but other than affordable also inside that project. There can also be a commercial space. Take for example the malls that we get to witness these days. You see that the malls are there commercial space, but there is also going to be residential spaces which are there inside the same buildings. Hence, taking that to set the context, one will be able to attach and appreciate how this actually works. Here as well, if it is going to be a affordable residential apartment, then the tax rate remains the same in spite of the affordable residential apartment being part of a real estate project which is not residential, which is commercial, because it exceeds the 15% commercial criteria. Then the tax liability does not change. It remains the same for an affordable residential apartment. It is 1.5% with deduction of land 1/3. So effectively the rate becomes 1%. And for other residential apartments which is not coming under the category of affordable, the rate remains the same. It is 7.5% without any ITC. With the deduction for 1/3 of land, it becomes effective rate of 5%. Now comes the interesting part. Not a residential real estate project, not an RREP, a commercial space. How does the GST rate apply? For this, the rate of GST is 18% with input tax credit. Now, this is where input tax credit is allowed. This is the only scenario where input tax credit is allowed. And here as well, though it is a commercial space, there is still an element of land that is involved in the transaction. Hence, 1/3 deduction is allowed. When that 1/3 deduction is allowed, the effective rate becomes 12%. This is how the rates stand as of today. This is the amendment that one had seen from 1st April 2019, post the introduction of the second wave of transition in real estate sector, effective from 1st April 2019. So these are the possible combinations and these are the possible rates at which a real estate transaction would get taxed post 1st of April 2019. Any project which had got completed prior to that, there is no need to worry about these rates. But any projects which were in existence, which were under progress, as on 1st April 2019, they had an option to opt for continuing in the old regime. If they had not exercised the option, they are deemed to be under the new regime, which is what we had discussed in the last 10 minutes or so with respect to residential real estate project, RREP, vis-a-vis an REP, a real estate project, which I coined a term called commercial real estate project. Now let's move further and analyze the impacts. So these impacts, as I said, the transition impacts have started from 1st April 2019. And for the projects which were continuing, the implication was that they had an option to move. But when they did not have a project which is ongoing as on 31st March, which is already completed, there is no such option. Any project which is started from 1st April 2019, no option. You have to continue with the new regime only. And for people who were under construction, the project is still ongoing as on 31st of March 2019, had an option to file the appropriate annexure and still continue with the old methodology of 12% with ITC, but only for the project which is ongoing, not for the taxpayer as such fully. Only for the project which were ongoing, they could have continued in the old. But once that project is over, everybody who is starting a project from 1st April 2019 had to come within the purview of the new regime only. The next aspect of this change, which is, as I said, from 1st April 2019, how did it change? The major change was with respect to the development rights. The development right given by the landowner, in other words, the transferable development rights, whichever way it is called, the taxability remained, but the tax liability was shifted to the shoulders of the promoter or the builder cum developer. The taxability of the apartments constructed and given by the builder cum developer to the landowner continues, and the taxability is still in the hands of the builder cum developer who is going to give it to the landowner. He needs to charge GST on forward charge. Now look at this scenario. If the landowner is not going to sell any of the apartment that he is going to get as consideration, then the landowner need not even bother about paying GST, meaning he does not have a need to get registered under GST. He doesn't have a need to pay GST. All that he needs to do is ensure that the builder cum developer takes care of the compliance. Because for the development right that is given by the landowner, the builder cum developer is going to pay GST at a reverse charge. And for the apartment that is given by the builder cum developer to the landowner, GST needs to be collected and paid by the builder cum developer on a forward charge basis. Now, whether this forward charge basis worked or was it a scenario where the landowner was asked to make the payment of tax to the builder cum developer, that is completely dependent on the contract that was entered between the builder cum developer vis-a-vis the landowner. Because in some of the cases, all the taxes and duties shall be paid by the developer is the wordings that they had used in the contract, which became detrimental for them post 1st April 2019 amendment, which meant that even the landowner share RCM they had to pay, and for the apartment that are allotted to the landowner also, they need to pay the GST. That is the builder cum developer. This resulted, and people who are careful enough, the builder cum developers who had already highlighted in their agreement with the landowner that any taxes and duties, the liability shall be on the landowner to the extent they are getting benefited, then in those scenarios, this issue was averted. people who did not specifically agree on this point, they faced an issue where the departmental action to collect from the landowner also ended up on the builder cum developer. Because they said from 1st April 2019, the liability completely shifted on you. So you as a builder cum developer are the one who is liable to pay GST, is what is the change that had happened. Hence, this issue could have occurred for many of the real estate constructing or builder cum developer taxpayers. The next element that we saw, where the landowner is selling his share of land, or whether the builder is selling his share of land, does not matter. The rate change alone need to be accounted for. If the landowner is going to further sell, that is, he is going to get the apartments allotted from the builder cum developer and he is going to further sell it, the landowner must get registered the GST and he is liable to pay GST on the transaction. Same way, a builder cum developer who is going to sell it to the buyer, his share, on that also he needs to collect and pay GST. Now look at this builder cum developer. He needs to pay RCM on the landowner's share for the development rights. He needs to pay forward charge, collect it from the landowner, or if it is not agreed, pay it out of his pocket to the department on account of the construction service that he is rendering to the landowner. And one more liability that is on the shoulders of the builder cum developer is whenever he is selling it to the buyer, the ultimate buyer of that apartment, if it is satisfying the conditions of being taxable, that is, any amount is received prior to the completion, then on those he needs to pay GST under forward charge by collecting it from the prospective buyer and paying it to the department. So that is how the compliance has underwent a change from 1st of April 2019. And this is the scenario that is existing even as of today. The other issue that we had come across, especially with respect to valuation, is the interpretation of section 15 subsection 2 clause A by the officers. Where in one scenario, what had happened was, this is the situation that we faced. Builder G had quoted price for the apartments as 60 lakhs plus stamp duty of 10%. Now, in this case, he said stamp duty of 10% is plus. Anyway, the stamp duty is going to be paid only by the buyer. He is going to collect it from them and he is going to make the payment. But he has mentioned that 60 lakhs plus stamp duty of 10%. Whereas, had he advertised like this, that the apartment is all inclusive 65 lakhs, what would have been the impact? Now, this is what was the interpretation the department officers were taking. Now, in the first case, what is the taxable value, or what do you think is the taxable value from the point of view of GST? You may give your answers in the chat box. What do you think is the taxable value in the first case, and what do you think could be the taxable value in the second scenario? So it is a question of 60 lakhs or 65 lakhs. In situation 1 and situation 2, you can give your answers in the chat box. Thank you. Thanks for those answers. Now, in the first case, what happens is department has interpreted the provision of 15 subsection 2 clause A in a different manner. And what it resulted was, it resulted in something like this, wherein they said, any taxes, duties, or cesses, if it is collected separately in a transaction, shall form part of the taxable value. Hence, in the first scenario, though it is collected only from the buyer, prospective buyer and paid, they said you are liable to pay GST on 66 lakhs. In other words, they took 66 lakhs as the basis, and from there, of course, the land related 1/3 deduction was given. All that is fine. But the base got changed. It was not 60, it was taken as 66. Whereas in situation 2, we don't have an option. We need to go for 65 lakhs only because that is the all-inclusive price that was quoted. Hence, that is how the tax liability was discharged, taking the 65 lakhs as the liability. Hence, based on 65 lakhs, the liability was computed. So, the issue that one might face with respect to valuation is this, where any taxes, duties, and cesses which are levied under any other law, but if it is charged separately by the supplier, will form part of taxable value, and based on that, department will raise the demand. Now I have two attendees raising their hand. Yes, Mr. Kalyana Sundaram, I'm allowing you to talk, sir. Please raise your question. Sorry, sir, I'm not able to hear you. Mr. Shravan Kumar, you had also raised your hand. Mr. Chandrasekhar. Fine, I think either they are not able to communicate or there is some restriction. Let's continue with the discussion.
So they can unmute themselves. We'll see if not. So
Sorry?
they can unmute themselves if they so raising hand. If we allow them to talk, they can unmute themselves. Actually,
Yeah,
there's no
I have
restriction.
done that. I have allowed them to talk, but somehow I'm
But
not able to hear them.
Maybe they might have not unmuted. Unknowingly raising hands.
Okay. Mr. Shaman, Chandrasekhar or Kalyana Sundaram, you have been already allowed to talk. Maybe if you want, you can unmute and ask me the question. Or
Yes,
if it is by mistake, then we'll continue.
Yes, sir.
Yeah. Now, as I said, from the perspective of every person, the landowner, the builder cum developer, and from the perspective of the buyer, how the taxability happens. From the perspective of the landowner is receiving the constructed apartments as a consideration. If he is receiving money, yes, that money is anyway a consideration liable to be taxable under GST. The onus is on the person who is giving the money, that is the developer, to pay the GST. But there is a taxability on that. And then whatever is being received as consideration, there is an element of GST that will be charged by the builder cum developer. Now that element of GST that is charged by the builder cum developer, this landowner is entitled for input tax credit, provided the landowner is intending to sell it further. I'll extend the example which I had taken earlier. That is, 100 apartments are being constructed in a joint venture, wherein 60 is being given to the landowner and 40 is being retained by the builder. The 60 that is being given to the landowner, of the obvious thing is the landowner is not going to utilize all the 6 for his personal consumption. He's going to sell something out of it. Now that he knows that he's going to sell something out of that 60, on all the 60, for the services that are rendered by the builder to the landowner, there would have been a GST that is charged by the builder to the landowner. On that invoice, the landowner is entitled to take input tax credit. And to this effect, an amendment was made in 2021 June as well, wherein it was clarified the time of supply need not necessarily be at the time of handing over. The builder cum developer can raise an invoice on the landowner, giving him the input tax credit as and when it is needed by the landowner. Why? Because the landowner might be receiving advances from the buyer. on which he will become liable to pay GST. What is the use of paying that GST in cash and later on getting ITC? So whenever he receives money from the prospective buyer, he can request the builder cum developer to raise an invoice on him. By virtue of that, he will be able to get the ITC, which ITC he can make use of for the purpose of making payment of his output tax liability. To that effect, the amendment was given, allowing them to take their input tax credit in the first place and allowing them to have an invoice even before completion. Consequently, the ITC can be passed on to the landowner. The landowner can use it for making the payment of his output tax liability, which was allowed, which was clarified. Now, more specifically, with respect to the landowner's taxability, whatever is the money that is being given to the landowner, that is the money that is being given to the landowner is taxable. But when the constructed apartments are being given to the landowner, then what is the valuation of it? How does the valuation need to be taken? This is where most of the issues cropped up, most of the valuation related issues were going on at length with various authorities. If we are to interpret Rule 27, how the taxability would pan out is either the open market value or the value that is adopted for like services or 110% of cost of construction. That is what in that order need to be taken as per Rule 27. Many a times resorting to 110% of cost of production was never allowed by the department because Rule 27 states only when A, B does not get satisfied, we need to go to CRD, which is 110% of cost of production, or Rule 31. Hence, when open market value is available, when the apartments are being handed over to the landowner, a similar apartment which is being sold to a third party, the value of that is available. Why not I make use of that is what the query that was raised by the department. For example, the apartment is being handed over to the landowner, where the construction cost will only be, let's say, 40 lakhs. But at the same time, an apartment is being sold, a contract is entered for sale of apartment with a third party, which is being sold at 1 crore. Now, it is very easy for the department officer to say, hold on, if you can sell at 1 crore, deduct 1/3 for land, the remaining is the building value. That is the value at which you are liable to pay GST on the building that is being given to the landowner. This continued as an issue for quite some time, but how the numbers happened, how this was eventually resolved is what has resulted in a major relief. This issue had, for all practical purposes, reached a finality by way of the Gujarat High Court judgment. But before getting into the Gujarat High Court judgment and interpretation associated with it, I have numerically put out the scenario where this 1/3 deduction can be really harmful. As you can see in front of you, there are two possible scenarios. One, an apartment in a prime locality is being sold as against an apartment in a developing locality is being sold. In both the cases, the cost of construction does not get altered. It is 2,500 rupees per square feet only. But still, the selling price in the prime locality for an apartment is 13,500 rupees per square feet. Whereas in the developing locality, it is only 7,500 rupees per square feet. So where does it create a problem? If the valuation is done as per notification 3/2019, which is amending the original notification 11/2017, is for the prime locality apartment, only 1/3 deduction for the land is given, which when I remove from 13,500, only 4,500 rupees per square feet gets removed, and the taxable value for the purpose of GST stands at 9,000 rupees per square feet. As against that, for the developing locality, 1/3 of land value, which is 2,500 rupees per square feet, gets reduced, and 5,000 rupees per square feet gets taxed. In case of a developing locality, it is not a problem because it is almost the elimination of 1/3 of land cost is almost equaling to my construction cost. Hence, paying GST on my construction cost is what I end up doing. So for the apartment in the developing locality, this 1/3 deduction is not detrimental. But on the other hand, for the prime locality apartment, if the 1/3 deduction is done, we end up paying GST on 9,000 rupees, which is multiple times the construction cost. 2,500 rupees is the construction cost, whereas I pay GST on 9,000 rupees, 6,500 rupees over and above the construction cost. I end up paying GST as a builder, or I end up collecting from the landowner and paying it to the department. Now, this is what has been put to rest by the Gujarat High Court in their judgment. Honorable Gujarat High Court in their judgment of Munjal Manish Bhai Bhatt had stated that the 1/3 deduction for land is not mandatory if the cost of construction is available. If the cost of construction is not available, we agree, you can go by 1/3 deduction of land. If the cost of construction is available on the apartments that are being allocated to the landowner, why should we go by the 1/3 deduction? Let us go by cost of construction. This has resulted in a welcome relief. An issue which was burning, which was litigated at various levels, has now reached a finality wherein we can say that the 1/3 deduction need not be applied in all scenarios. If cost of construction is available, we can go by cost of construction, pay GST only on that value, which is reduced a huge chunk of cost on the real estate's budget. Further, the landowner, as I said earlier, can take input tax credit, but it must be based on the invoice from the builder. Another common issue, which is a procedural problem that we have come across, is the builder developer does not raise an invoice on the landowner. They say, okay, fine, we will pay GST. They factor the GST and they make the payment of GST, but they do not issue an invoice. They must issue an invoice because the basic consideration is not going to change hands, but the GST either will be paid by the landowner, or even if that is agreed and part of the consideration, the builder cum developer has to pay the GST from his pocket. But the benefit of the GST, if the landowner wants to make use of, then invoice is a must. And if the landowner is a registered person, only then he can make use of that ITC. So giving an invoice, reporting it in GSTR1, consequently it getting reported in GSTR2B of the landowner are all required to satisfy the conditions of availing the input tax credit. And that is what will make the landowner eligible for that input tax credit, which he can offset against his liability when he is selling to a third-party buyer. The GST liability arising on the transaction, he can offset against this input tax credit, which has got accrued to him on account of sale that he has made, on account of the invoice that he has received from the developer. Yeah. Mr. Anand has raised. Yes, sir, I have allowed you to talk. If you have a question, yes, please.
Hello.
Yes, sir.
Sir, you told a builder can avail the, or landowner can avail the input tax credit. That time, he cannot take that concession rate of 5%. Then he has to charge the ultimate buyer 12% only. Then only he is allowed to take a credit. Am I right?
Sir. No, sir. It is even for this residential apartment, he can take the input tax credit. This is to nullify the cascading effect of taxation. If the landowner is going to, anyway, what is getting allotted to him is a residential apartment. It has already suffered GST by way of the builder collecting on the developed, that is the building charges. Now, one more time, if GST is levied without input tax credit, this will make the landowner share of sale of apartment costlier than what is being sold by the builder.
Okay, you are right. Yeah, yeah.
That is the reason why this input tax credit was given, and that is the reason why this has been clarified in the 2019 FAQ as well. And subsequently, they have paved way for the builder to give an invoice even before completion to enable the landowner to take the input tax credit, because his liability to pay will occur before completion only. Whenever the apartment is getting booked, that liability, the landowner can very well use this input tax credit to make the payment.
Okay. Even though he is selling it for 5%, he is allowed to take a credit.
Exactly. That is the unique scenario they want to address.
Okay.
And that is the reason why landowners will also have to get registered. If the landowner is not going to get the apartment sold, whatever he is getting allotted, he is not sell it, he never has to get registered under GST.
Okay.
Now
Sir,
imagine a person who is having a single ground of land, giving it for joint development, getting 2 apartments, retaining it for his own consumption. He doesn't even have to bother about GST. That is how such people have been relieved from the responsibility from 1st April 2019.
Okay. Sir,
Sorry, sir. Yeah, you have to unmute yourself.
Sir, one more question. See, when the builder transfers the apartment to the landowner, he builds that, he transfer it to the landowner, and also he raises the invoice. In the meantime, builder gets the completion certificate.
Yeah.
So ultimately, when he is selling it to the outside party, it is without GST, as I understood from your discussion.
No, sir. There are 2 possibilities. For example, the 100 apartments, I'll take the same example. 60, the landowner knows is belonging to him. And 40, the builder knows is belonging to him. The day they start the work itself, they will start marketing. While the marketing happens, the landowner share of apartments may get sold. There might be a booking. For that booking, when the landowner takes the money, he is liable to pay GST now. That is when the landowner should insist upon the builder to give him an invoice. Now, this invoice is for the ultimate 60 apartments that he is going to get. Out of that, a proportion or a percentage in terms of how much is completed, which is mutually decided between them, an invoice can be given by the builder to the landowner. To that extent, the landowner can immediately take input tax credit, and whatever liability he needs to discharge on account of the apartment that has got booked, for which he needs to pay GST, that GST he can offset against this ITC.
Okay. So after completion, whatever he is selling, he need not collect the GST, and he need not take.
In those cases, out of the ITC that he had availed, let us assume out of the 60 apartments, only 40 has got booked before completion. Remaining 20 is not getting booked. He would have availed the ITC for all the invoices that is received from the builder. Now, 1/3 he needs to reverse.
Okay. At what time, sir? At what time? After once he receives the OC?
Yes, on completion, sir. Why? Because, as you rightly said, after completion, he is never going to be entitled for it. There, he need not go and do the reversal as per value. He needs to do the reversal as per the remaining 20 apartments carpet area.
Proportionate.
Yes, proportionate carpet area. Because when I say 20 apartments, some might be single bedroom, some might be double bedroom. So we need to go by the overall carpet area. Out of it, unsold carpet area proportion, we need to reverse.
Okay. Thank you, sir. Thanks for clarification. Thank you very much.
Now let's get ahead with the landowner's share, where, as I said, the landowner can dispose of his liability by utilizing the input tax credit, which he is getting it from the builder by way of his invoice. The other party who is now liable to pay GST is the builder cum developer. Now, from his perspective, the first liability that he needs to discharge is the taxability of the development rights. We can call it as FSI, TDR, or long-term lease, whichever way it is. That is the development right which is given to the builder cum developer, on which, what is he supposed to do? He is supposed to see whether it is pertaining to a residential or other than residential, which is the commercial aspect. If it is for a residential real estate project, then on the units which are sold before the completion certificate is obtained, then to that extent, he need not pay GST reverse charge on the development rights. For example, I have taken the joint venture agreement. The landowner has given me the land. I am constructing 100 apartments. All have got booked before completion. Then I don't even have to pay anything called reverse charge on development rights. But if some are pending, some have been booked, then I need to proportionately reverse the input tax credit. Rather, I need to proportionately pay the reverse charge to the extent of whatever is remaining unsold, where I have an option, that is, I need to pay 18% reverse charge, or I can restrict it to 1% or 5%. Why 1% or 5%? If it is an affordable residential apartment, then 1%. If it is other than that, it is 5%. I can restrict it to 5% or 18% or 1% or 18%, depending upon my calculation. Generally, it tends to be either 1% or 5% only. 18% is not warranted in most of the scenarios, but it can occur in some of the scenarios. So the reverse charge is certain, but the reverse charge has to be expunged looking at the two possibilities. On the other hand, if it is going to be not a residential, it is commercial, then in all the cases, reverse charge at the rate of 18% needs to be paid on this development rights or FSI or long-term lease. But the good thing is pay the reverse charge, avail the input tax credit. But in all these cases, whether it is residential or commercial, all these cases, only the builder cum developer, he is the one, he is liable to pay GST under reverse charge. And further, the liability which can occur not just from the consideration, that is the non-monetary consideration, it can also occur from the monetary consideration, which as I said earlier, when the liability needs to be discharged. The liability needs to be discharged on completion certificate or on completion or first occupation. Yes, that is the time of supply. But if invoice is issued prior, which is what I told you earlier, that is allowed. If the builder gives an invoice earlier, that is allowed. As long as builder gives an invoice earlier and pays the tax, the landowner becomes entitled to the ITC. He can also enjoy the ITC. So if he doesn't do any invoicing before completion, he has to mandatorily do the invoicing on completion and pay the GST. If he gives invoice prior to completion, then at the time of giving invoice, he is liable, and whatever is pending on completion, he is liable to pay GST. That is how the liability needs to be settled on account of what is getting allotted or what is getting remitted to the landowner by the builder. And now further, one more liability, the responsibility to pay this liability is on the shoulders of the builder cum developer, that being the reverse charge. The reverse charge liability on account of procurement from unregistered dealers. Section 9, subsection 4, something which was terrorizing most of us when GST got introduced from 1st of July 2017. And thankfully, it got suspended from 13th October 2017. The suspension continued for quite some time. An amendment was proposed in 2018 Amendment Act. 9 subsection 4 was completely recast, and it said that procurement from unregistered people will be subjected to GST reverse charge, but that will be subject to a condition that only for notified type of taxpayers it will become applicable. And that notified type of taxpayer, the first one to get notified from 1st April 2019 was a real estate promoter cum builder, who got notified as a person whenever he is procuring goods or services from unregistered person. He was made liable to pay GST under reverse charge, but they did not make it applicable on a gross basis. They went about giving some benefits as well in terms of reduction. What they said is not lesser than 80% of your inward supplies, be it input or input services for a project, should be from registered persons. Then there is a leeway or an allowance to the extent of 20%, which you can procure from unregistered people, which is allowed. If that is the scenario, there is no reverse charge that is going to get arised on account of this RCM. But if there is going to be a shortfall compared to this 80% expectation, then the shortfall amount, that is procurement from unregistered people vis-a-vis procurement from registered people, if procurement from registered people is going to fall below 80, let's say it is 72, then between 72 to 80, that 8% value needs to be compensated by this promoter cum developer, where he needs to pay reverse charge on that 8% value. While calculating the cost of the project, there are certain costs which were allowed as a deduction to calculate this 80%, because on a total cost, these will be there. That is the development rights cost, the electricity cost, the the motor spirit cost, diesel or petrol, which is used while doing the construction, maybe for the generator, for any other purposes. And then the salary and wages, which are paid, which is not basically covered under GST. When all these are there, these can be removed from the cost of the project. And then whatever is the cost of the project, on that, not lesser than 80% should have been procured from registered people, is what is the expectation. If that is satisfied, there is no reverse charge. If that is not satisfied, for the shortfall, reverse charge will occur. And how to expunge that reverse charge? That reverse charge shall have to be expunged in the following manner. That is 18%. A blanket rate of 18% is the one which needs to be paid. And there is a small fine print that needs to be appreciated, which is if that shortfall, in that shortfall, procurement of cement from unregistered people is there, then it is not 18%. The GST reverse charge at the rate of 28% shall have to be paid. That is what is the fine print that is there. So generally people tend to pay 18% calculating this. But if it is on account of procurement of cement from unregistered person, then this 28% reverse charge shall have to be paid under 9 subsection 4, which is the third liability on the shoulders of a real estate promoter developer. So look at the responsibility of the promoter developer. Pay reverse charge on the landlord portion, collect and pay the forward charge on landlord's allotment, collect and pay GST on the buyer's share, pay reverse charge on the unregistered person procurement. The responsibility of the real estate sector, sector taxpayer has increased multifold from 1st April 2019, which is why we are seeing that the growth in that industry is at a very slow pace, because compliance has been the challenge from 1st April 2019. Now, this reverse charge is going to be applicable only when the taxpayer is going to pay under 1% or 5%, which is the affordable or other than affordable residential cases. In case of commercial, there is not going to be a requirement to pay this reverse charge, because it is quite straightforward. The neutrality of revenue is the logic, the reason behind why they don't have to pay, because if they are going to pay under reverse charge, they are going to be eligible for input tax credit on the other hand. Hence, in those scenarios, this reverse charge is not envisaged to be paid by the developer. And finally, on the other procedural compliances which needs to be taken care by this developer come promoter, is that the books of accounts must be maintained project wise. The records and documents must be maintained project wise, because the information sought by the department always is on a project basis. It is not on an organization basis. Though the GST returns may be filed for the whole state as one return, every project shall have to be treated as a separate transaction, and for every project, the calculation, the records and books must be maintained to be able to answer any questions that are posted by the department. And this 80% reverse charge that we discussed, this shortfall, if it is going to be attracted, then that needs to be charged on a yearly basis. That needs to be expunged on a yearly basis. Why yearly basis? Because there are possibilities that a project can run across financial years. If it is going to run across financial years, we need not wait for the end of the project to fulfill the obligation of reverse charge of 80% for shortfall calculation. This can be paid even during the life of the project, but we can have a calculation on a yearly basis and maybe pay it in the March month return as a standard procedure. This will ensure that on a yearly basis, the liability is getting expunged. And on the invoicing, which needs to be done, construction service per se will fall under the category of continuous supply of service. Section 2, subsection 33 defines continuous supply of service as a service which is rendered for a period exceeding 3 months. Hence, we are looking at a scenario where the construction service is going to be the completion. It will easily be 3 months. It will always be 3 months, unless there is going to be an exceptional scenario. It will always be more than 3 months. So this real estate transactions will invariably fall under the category of continuous supply of service, wherein when the invoice should be raised would be dictated by the provisions of section 31 subsection 5, which states that the invoice can be raised depending upon the one of the 3 conditions or one of the 3 scenarios under which it falls. 1, the payment due date. If it is ascertainable in the contract, then on the due date of payment, invoice should have been raised and GST liability will accrue on that day. If there is no payment due date is available in the contract, then the date on which the payment is made shall be deemed to be the time of supply. That is the date on which the GST should have been paid. There is another possibility, which is most common that we have seen, is the contract between the real estate and the real estate company and the buyer always tends to be mentioning a milestone, an event. If it is going to be based on an event, then on happening of that event, invoice should have been raised and GST should have been paid. The real estater might have raised the invoice belatedly. That does not count. The department officer will still say, as per the contract, you are liable to raise the invoice the moment the event occurred. The moment the event occurred, you are liable to pay the GST. Hence, this procedural aspect need to be carefully kept in mind while even drafting the contract of sale, the agreement for sale between the one who is selling the apartment vis-a-vis the one who is procuring it, where they should have been adequately provisioned, and based upon that only the trigger event of invoicing will occur. Based on that only the liability will happen. Hence, this is another area where there could be an issue in the real estate sector, which needs to be procedurally addressed. And that is all that I had in my mind for today's discussion. Now, what I suggest is, I have questions in the question box in front of me, which I will take one by one, post which I can unmute few of you and take your questions as well. Now, there is a question stating that, is GST liability there on owner share of flats after receiving the completion certificate? Be it owner share or the builder share, does not matter. That apartment per se, no money is received before completion. If it is sold after completion, there is no question of GST on the transaction. Is WCT applicable on repair services for building where the contractor is rendering services to government company? Sir, WCT is works contract tax, which was in the erstwhile GST, is erstwhile VAT law, which does not find a place in GST. In GST, if you say it is a government company, I can foresee only one thing here, which is GST TDS under section 51, which is not works contract TDS, which is a GST TDS. That will certainly apply for a transaction with a government organization. So that might be the one which you would have faced in a scenario. In case of JDA, what will be the time and value of supply in case of residential plotted layout for development rights and consideration for builder will be the area sharing. Now, I'm not able to get the complete information from this question. Plotted area layout, you are saying, what we discussed earlier, the layout is being sold. Then there is no question of GST on that. There is no value of supply or time of supply that needs to be taken into consideration. As far as the construction is concerned, it is falling under continuous supply of service category. So what we just now discussed shall be the driver as to what is the trigger event in your contract will decide when the time of supply will occur. There is another question from Mr. Ashutosh Agarwal, which says real estate project started in 2020, ITC utilized, if any is until sale of units before completion of construction. Thereafter, all ITC belonging to such project was never taken as sales were made after construction. One such unit of the project is sold in 2022. Now in 2022, the entity has only provided interior services where GST has been charged for all the services and ITC taken accordingly. In 2022, we have nil rated sale and taxable sale. Should we again reverse the ITC? The department is of the contention that where there is nil and taxable sale are there, proportionate tax is to be reversed. What I can understand from your question is already the reversal has happened. Now, currently, do we have to do a reversal? Certainly not on the ITC portion that has already been availed. Now, if you had availed any new ITC in the current period, if it is only common or if it is only pertaining to this nil rated or exempted supply, reversal is required. Else, reversal is not required. The another question is, if registration charges paid by the buyer directly, it is not taxable. Yes, if it is paid directly, you are not going to be made taxable for it. I think you are referring to the case study which I had raised. Yes, where I have clearly mentioned the builder said it is plus registration charges. If I had not mentioned plus registration charges, the problem wouldn't have occurred at all. If the developer does not collect from buyer and makes him pay to SRO directly, what is the status? The same as we just now discussed. There is not going to be a GST on that because this was raised by the officers interpreting 15(2)(a). The scenario that you are talking about, there is no money that is going to flow into the books of the developer. So there is not going to be a situation of GST liability on that. The landowner sells the developed plot flat to the buyer after such plot/flat is transferred by the builder to the landowner is taxed in the hands of the landlord. Sir, it doesn't matter whether it is after this, it is transferred by the landowner, the landowner sells the developed plot to the buyer after such plot is transferred by the builder to the landowner. Okay. But is it in relation to an apartment or a construction flat which is completed or before completion? That is what matters with respect to the taxability. When 18% are RCM on TDR, I think I have already explained that scenario. Okay. Can input credit of one project be adjusted with the output of another project? Yes, there is no specific exclusion on that. As long as you are eligible for the ITC, yes, it can be. Is there any minimum number of units required for GST applicability? No. For RERA only there is a minimum number applicability, not for GST applicability. What about GST applicability on builder involved in construction single residential units? Single residential units, there is an exemption that is there. If he is going to be using that is works contract. So that exemption would not occur or would not hamper the construction or real estate related taxability. How 1/3 abatement claimed in GST return can be net off? Please explain. 1/3 abatement, my suggestion is take the taxable value which is netted off only and report it in the GST return. Whereas when we report invoice value, you report the total value plus GST. That is how it should be overcome. If a developer entered JDA before 31/3/2019, can he opt for output tax 12% with ITC? He could have opted only until May 2019, I believe. Now you cannot opt. It should have been opted at that time itself. What is valuation mechanism for GST in case of plotted development projects? As I explained earlier, if it is only going to be sale of land, there is no GST. Hence, you don't have to worry about it. In case of JDA, the landowner share of flats, he is not going to sell the share of his property. Still, the builder has to raise an invoice of construction. Yes, for the builder to discharge his liability, he has to raise an invoice. But there is no question of ITC in the hands of the landowner. Hence, comply with the procedure. There is no question of ITC. It is like a B2C transaction. Let it be done the same way. If carpet area wise reversal should be done only after CC, yes, you are talking about the carpet area wise reversal of the ITC. In case of completed projects, yes, under rule 42, it is based upon carpet area after completion. In respect of the ones which have not been booked at all. Before CC, it is based on value? No. Whether it is before CC or after CC, it is only after CC, and it is only based upon the carpet area. That is how the Rule 42 has also been amended specifically for the purpose of real estate projects. Will affordable residential apartment definition be applicable to plotted layouts also? Tough to say. Plotted layouts, how you are selling it depends upon that contract. It needs to be interpreted. It can be fitted. GST applicability if land taken for development for plotting and developed plots are handed over to the landlord. There is a development activity that has happened. For the development activity, GST will certainly be applicable. On the land, there is no question of GST. In a scenario where landowner takes his share of flats with invoice from builder and opt to sell after few years, still he can avail the input tax. Yes, he can avail the input tax, but imagine the ITC has been availed, but the construction got over, and after that he is selling. That is, the ITC has to be reversed, as per Rule 42, because this ITC is pertaining to the apartments. And if anything is remaining unsold on the date of completion, he has to reverse the ITC. So this ITC cannot be carried forward forever and utilized for any other purpose. While it is eligible and continuing, can I use it for some other purpose? Yes. But reversal must be done on the date of completion. Keep that in mind while doing this. Reversal should be done after CC only, sir. I'm assuming that your question is from the perspective of the builder. Yes, on CC only there is a question of reversal. In case of residential property, we are requiring to pay 5% GST on sale value. Whatever input on purchase is ineligible, where do we have to mention in 3B the reversal of input? It is ineligible, hence the revised requirement to report it in GSTR 3B. As per that, you need to show it as reversal others in table 4B2. That is how it should be reported. Now, those were the questions that were there in the Q&A box, which I have addressed. If there is still any question by any participants, you can either post it in the Q&A box, or you can raise your hand, then I can unmute you. In JDA case, the valuation and tax rate of landowners' share of plots. Please understand, the landowner's share of plot, I am assuming land. It is already in the name of the landowner, so there is no need for valuation. Only what is going to be constructed on that and given to the landowner needs to be valued, which if you have the cost of construction, accordingly you can do the valuation. So Arun Prasad has raised his hand. I am asking you to unmute. Yes, Mr. Arun Prasad, if you have a question, you can go ahead. Fine, I think there being no other question,
Yes.
I got to thank you all for your patient hearing. And sorry, Mr. Ganesh Babu is raising his hand. I need to unmute. Yes, sir, you can unmute.
Hello.
Yes,
It's audible. Hello.
Yes, Mr. Ganesh Babu, you are audible.
So the builder has to pay two GSTs actually, the one for the value of the TDRs and one for the value of the sale of the flat also actually.
Correct.
Right?
Correct. Plus whatever is getting allotted to the landowner, on that also he needs to pay GST, but that can be mutually agreed and collected and paid.
But these two GSTs are particularly belonging to the flats which are submitted to the owners, right? There is the landlords actually. One is for the regarding the TDR actually. These are transfer development rights.
Correct.
This is one of the services which has been given to the landlord actually.
Yeah.
And one more was the flats which have been given to the landlord actually.
Correct. These two are pertaining to the landlord portion.
The same service has been given, and for the same service, the GST has been paid twice actually. Is
By
it
the
right?
landlord.
By the builder actually. Builder has
By the
given
builder.
the completed flats, and builder has taken the service of the TDR actually. For
Okay.
the same service, actually GST was paid twice, right?
No, sir. For the whole project, the TDR based reverse charge has to be calculated.
Okay.
Okay. Out of that, I'll go by my same example. 60 is to the landlord and 40 is to me. For the
Yes.
whole project, I need to see whether reverse charge is becoming applicable. Out of this 100, 80 gets sold before completion. Then only for 20, I need to pay reverse charge.
Sorry, sir, I didn't get it actually.
The landlord, there is a development right for which I need to
Yes.
pay reverse charge. But
Yes.
there's an exemption to the builder if it is residential apartment. That is, if I am going to pay reverse charge, I don't have to pay on 100.
Okay.
I need to pay only on those apartments which are remaining unsold for the whole project. My share as well as the landlord share, which is remaining unpaid, unbooked or unsold on the date of completion. On that only I need to pay reverse charge.
So in case, in case all are unsold, then he has to pay completely, right?
100%. You are right. He needs to pay on the full value.
Yeah. See, the same. Actually, he has given the one service. It's a TDR.
No, it is getting taxed only once. See, if I am going to pay, if nothing is booked, government will get GST on this TDR once.
Yes.
And on the final apartment that is sold, the government will never get GST, no? Because it is after completion.
Okay. So after completion, okay. So
that is how they have ironed out the circular or the cascading effect.
Okay. Fine. Fine. Sir. Thank you.
Yeah. Yes, sir. Mr. Kulkarni, you have raised your hand.
Sir, sir, thank you very much for enlightening. It's a very nice seminar. Sir, one more question.
Yes,
when we are paying on the developmental right, reverse charge, under reverse charge, on what value I have to pay? See, in agreement, I have not mentioned anything like cash has to be paid. In sometimes what happens, out of 100 rupees, I pay some in cash and some in the form of flats, I will get it. It involves both. If I know the amount, I can pay. But here, on what value I have to pay? Because I know that on the whatever the built apartments have been transferred, you told that it is a similar value or something like that.
Yes.
But on the valuation of on reverse charge, on what value I have to pay the reverse charge?
No, that is where I will still resort to the Gujarat High Court judgment for this angle also. What I have given to my landlord to get this, that is the landowner, to get this development right, is consideration in kind. The consideration in kind is nothing but the apartment that I have constructed and given to him. Okay. So I will take the same construction cost, pay reverse charge on that.
Okay. Entire construction cost I have to value and as on this one.
Yes, entire, but which is proportionate to the apartments which are remaining unsold only.
Correct, but that I will come to know only on
completion.
Completion. Yes. Up to completion, I am not supposed to pay reverse charge.
Exactly. That is where what will happen is keeping construction cost as the tab will help us budget. If they say you have to pay by the apartment's cost, by the time the project is completed, the cost will be escalating or the apartment's price will be escalating. So we would never know where the liability will stand. Okay.
To get rid of it, can I say that, see, totally I am agreeing that out of total 100 flats, I am giving back 60 to the owner and remaining 40 I am taking it. To get rid of it, so can I say that some portion is given in the cash? On that I can pay the reverse charge and remaining on forward charge is something like that I can do.
No, sir, there is no forward charge. In this case, whenever you pay in cash also, you need to pay under reverse charge.
Yeah, because reverse charge only.
The money goes. You have to pay immediately.
Oh, okay. Yes, sir. Thank you, sir. Thank you very much.
Yeah, sure. So as I was about to say, thank you all for your patient and effective listening. Over to the organizers now.
Yes, sir. Thank you so much, sir, for your excellent session and for answering all the questions for more than half an hour's time. And on behalf of chairman, secretary, and office bearer in the absence, we thank you so much for your time spent here, sir, and for a continuous support to SIRC physically and virtually also over the period of time. And we'll look forward to have much more sessions. Yes, sir. Thank you so much. And many were asking for the PPT. If can be shared, you can share as a soft copy. So
I will send it as an email right after
yes, sir,
this.
please. Yes. Thank you so much.
Thank you.